Thanks, Janice. Good evening to all of you. Welcome for joining Q4 and full year FY18 results ended 31st March 2018 of Majesco Ltd. Please note that the results are being mailed to you and you can also view it on our website www.majesco.com. To take us through the results and answer your questions today, we have with us Mr. Qtr4, Non-Executive Director of Majesco Ltd. And founder and CEO of Majesco US, and Mr. Farid, Managing Director of Majesco Ltd. We will start the call with a brief overview of the quarter and full year, which will be given by Mr. Mehta, and then that will be followed by Mr. Farid, who will go into the detailed financials. We will then follow this with Q&A session. I would like to remind you that everything that is said on this call that reflects any outlook for the future, or which can be construed as forward-looking statement, must be reviewed in conjunction with the risks and uncertainties that we face. These uncertainties and risks are included but not limited to what we have mentioned in the prospectus filed with SEBI and in the subsequent annual reports that you can find on the website. With that said, I would now like to hand over the call to Mr. Qtr4. Over to you, sir.
Thank you, Asha. Good evening, everyone, and welcome to Majesco's fiscal 2018 fourth quarter and full year conference call. We are pleased with our record fourth quarter results and the accelerating business momentum we are experiencing throughout different parts of our business. We had record revenue of 216.7 crore, which increased 5% over the previous quarter, adjusted EBITDA margins of 9.4%, which is 298 basis point improvement over the previous quarter, and a record 12-month order backlog of $92.6 million, which is 41% higher than a backlog a year ago. I am also pleased to see that we achieved a net profit of Rs 10 crore in Q4 FY18. We made good progress transitioning our business model from on-premise to cloud during the year. As you know, in such a transition, we sacrifice initial implementation revenue in favor of profitable long-term recurring revenue of cloud subscription. Majesco experienced a 25% decline in on-premise revenue during the fiscal year. However, we successfully grew the cloud revenue by 51% during the year to offset this decline in on-premise revenue. Cloud revenue now represents over 31.3% of fourth quarter revenue compared to 18.9% of the same period last year, which is a significant shift in our business model. Our cloud subscription revenue is scaling as a result of clients putting more business on our platform. Cloud subscription revenue increased by 54.5% and represent 8.9% of total revenue compared to 6.6% in the same quarter last year. As a result of growth in cloud, we saw total revenue continually improve throughout the year. Revenues went from Rs 183 crores in Q1 to 199 crores in Q2 to 207 crores in Q3 and 216 crores in Q4. This is a growth of 8%, 4% and 5% in Q2, 3 and 4 respectively. As a result of cloud transition, we also improved total recurring revenue base by 53% in Q4 FY18 compared to the same quarter last year, which now makes up 28.2% of Majesco revenue in Q4. As a result of this improvement in revenue and increase in cloud portion in our portfolio, we experienced increase in profitability. Our adjusted EBITDA margin improved from negative 0.7% in Q1 to 3.4% in Q2, 6.4% in Q3, and 9.4% in Q4. Overall, this is 601 basis point improvement in EBITDA margins over the same period last year. With this financial overview, let's look at what is driving the demand. Over the course of past years, I have talked about disruption taking place in the insurance industry, which is creating significant opportunities for Majesco. Insurance industry is behind retail, travel, hospitality, and music for digital disruption. The opportunity is so compelling that over 19 billion of institutional and strategic investment went for over 1,500 new insurtech startup companies. In recent research, McKinsey found that companies which spend upper quartile of technology investments grew twice as fast and are 6% more profitable compared to their peers. The insurance industry is in the early stage of what we call digital insurance 2.0 that is underpinned to meet new customer experience as well as new products and services to meet their unique needs. As a result of these changes, we see reduction in large multi-year transformational initiatives in favor of agile innovation initiatives driven by new product introduction, improving customer experience, and creating new business models. For this initiative, insurers are focusing on speed to value and looking for solutions which will enable them to pay as they grow. Cloud platform solutions are ideally suited to address these needs, and Majesco has a strong competitive position in this fast-growing segment of the business. To serve the growing needs of insurance carriers, over the past years, we have enhanced all our platform solutions, including a major release of Majesco PNC Suite and Majesco Life and Annuity and Group Suite. These releases are focused on optimizing our solutions for the cloud and delivering speed to value to our customers. Over the last couple of quarters, we have created a number of proof points of delivering speed to value and enablement of growth and innovation for our clients like QBE, American Family, Homesite, and others using Majesco platform. I am very excited with the recent announcement of our cloud-only digital-first platform solution. There are a number of unique capabilities of our digital-first platform. Digital-first is a microservices-based platform which enables carriers to consume capabilities on demand and at a much faster pace. For example, we expect to roll out a personalized customer engagement application in a matter of weeks as opposed to months it typically takes for a traditional portal. The platform also includes EcoExchange, which is an app store-like marketplace allowing an easy integration with broader industry ecosystem, including some innovative capabilities of insurtech companies. We see a growing interest from our partner community to build apps for EcoExchange, and we are excited about its potential. Our joint IBM and Majesco team is executing on MetLife program we previously announced. In addition, our IBM partnership continues to gain momentum with a growing pipeline, and we are actively pursuing several opportunities to Tier 1 and Tier 2 insurance carriers in both life and annuity and PNC markets. During the fourth quarter, Majesco had a total of 4 new customer wins, representing growth in North America. Specifically, 2 insurtech startups selected Majesco's platform solutions, including Majesco's PNC Suite and Majesco's Cloud Insurer. A Tier 1 insurer selected Majesco's PNC Billing for their greenfield operations, and a Tier 2 insurer selected Majesco's PNC Suite and Majesco Cloud Insurer. In addition, we had a Tier 1 insurer extend our existing relationship and select Majesco's ADM services for 3-year period. Finally, and most importantly, we had 3 go-live events during the quarter. This includes 2 Majesco billing customers and 1 which was a Tier 1 insurer and 1 customer that went live with Agent Portal. Our fourth quarter results validate our strategy and demonstrate Majesco's leading position to support growth and innovation initiatives of the insurance carriers, an area which we expect continued investment by the carriers. I am excited to support our customers' transition to digital insurance 2.0 and the opportunities to grow our business in fiscal 2019 and beyond. Let me now turn the call over to Farid to discuss the financial drivers for the quarter and a full year. Farid?
Thank you, Ketan, and good evening to everyone on the call. I echo Ketan's sentiment that we have ended the year extremely strong as compared to the start of the year, and management has taken significant steps to achieve this turnaround. Let me enumerate the key highlights from the overall quarter 4 and full year performance. This has been the third quarter of consistent improved financial performance and business growth momentum. The operating revenue for the fourth quarter ended 31st March 2018 was 216.7 crore, reflecting an increase of 14.3% Y-on-Y and 4.5% sequentially. In constant currency, the growth was 3.6%. The operating revenue for the full year ended March 31st, 2018 was 806 crores, reflecting a marginal growth of 0.9% in constant currency, but in terms of profile, it improved significantly towards a cloud-based model. In terms of total revenue for Q4, we ended up at 221.6 crores, reflecting a growth of 15.7% Y-on-Y and 6.1% Q-on-Q basis. For the full year 2018, the total revenue was 817 crore as compared to 835.8 crores in FY 2017, reflecting a degrowth of 2.3% in rupee terms. During the quarter, our adjusted EBITDA stood at 20.4 crores, which is 9.4% of the operating revenue as compared to 6.4 crore, which was 3.4% of the operating revenue in the Q4 of the last fiscal, indicating an improvement of 601 basis points year-on-year, while sequentially this quarter showed an improvement of 298 basis points. For the full year 2018, the adjusted EBITDA was 39.2 crores. The margin stood at 4.9% as compared to 4.9% in the last year too. This year's EBITDA reflects a significant turnaround in profitability over the 4 quarters, especially as we started the year with a weak Q1, where the EBITDA stood at a negative 0.7. The consistent growth in revenue and improved profitability out of all the initiatives that we have taken has resulted in a net profit for the 4th quarter at rupees 10.1 crore, and for the full year we achieved a net profit at 2.8 crore. Total revenue from cloud-based customers was 67.9 crore, which is 31.3% of the operating revenue for the 4th quarter ended 31st March 2018, as compared to 63.8 crores, which was 30.8% of the operating revenue in the quarter ended 31st December 2017, reflecting a growth of 6.4% Q-on-Q and up 90% as compared to the 35.8 crores, which was 18.9% of the operating revenue in the corresponding quarter of March 2017. For the full year 2018, the total revenue from cloud-based customers was 239.9 crores, which was 29.8% of the operating revenue, as compared to 159.1 crores, which was 19.3% of the operating revenue in FY 2017, reflecting a growth of 50.7% on a year-on-year basis. This helped more than offset the drop in the on-premise services revenue, which degrew 25% in the year FY 2018. The total recurring revenue was 61.1 crore, which was 28.2% of the operating revenue for this quarter, as compared to 39.9 crores, which was 21% of the operating revenue in the Q4 of last fiscal. For the full year 2018, the total recurring revenue was at 215.4 crores, representing 26.7% of the operating revenue, as compared to 196.7 crores, representing 23.8% of the operating revenue for the previous fiscal. The cloud subscription revenue was 19.4 crores, which was 8.9% of the operating revenue, as compared to 12.5 crores, which was 6.6% of the operating revenue in Q4 of last fiscal, reflecting a growth of 54.5%. For the full year 2018, the cloud subscription revenue was 72.5 crores, which is 9% of the operating revenue, as compared to 46.5 crores, which was 5.6% of the operating revenue, reflecting a growth of 55.8% on a year-on-year basis. The 12-month backlog stood at 606.5 crores, which was $92.6 million as of 31st March 2018, as compared to 587.3 crores, which was $91.9 million at the end of Q3 FY18, reflecting an increase of 3.3% in Q-on-Q in rupee terms and 0.7% in dollar terms. The backlog grew 41% as compared to 65.7 million last year. Further, the composition of the cloud revenue was 42% in the 12-month backlog ended 31st March 2018, as compared to 29.2% for the period ended 31st March 2017. The year saw good traction from both new client wins and existing clients. Total contract value of new and existing client wins during fiscal 2018 totaled 1,436 crores, which was $220 million for FY 2018. The new deal wins were registered across all regions, with 9 coming from North America, 3 from the India Asia Pacific region, and 1 from UK. Notably, 7 of the 9 IP deals in North America were cloud deals. We added 4 new clients during this quarter. The total active clients is now 175, and the total number of cloud customers now stands at 37 at the end of 31st March 2018. In terms of client concentration, the top 5 constituted 32% of revenue, and the top 10 constituted 44.9% of revenue for Q4 2018. For the full year, the top 5 and top 10 constituted 28% and 42% respectively. We continue to make the investments in our product development speed. The product development expenditure remained flat during the quarter at 30 crores, which is 13.8% of the operating revenue. However, the investment of products were realigned to the development of new products within the group life, PNC and PAS, and our digital forays. For the full year ended 31st March 2018, the product expenses stood at 112.6 crores, which is 14% of the operating revenue. Quickly turning on to the balance sheet, the total debt as of 31st March 2018 was 91.9 crores as compared to 72.2 crores as of 31st March 2017, whereas the cash and cash equivalent was 398.6 crores at the end of March 2018 as compared to 175.7 crores at the end of 31st March 2017. To conclude, the fiscal 2018 has been a year of transformation, ending significantly stronger with good visibility of growth and profitability in the coming years. This concludes our prepared remarks. I'll now pass it on to the operator to please open the call for questions. And thank you very much for your continued interest in Majesco.
Thank you. Ladies and gentlemen, we will now begin with the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. A reminder to the participants, if you have a question, you may press star and 1 at this time. We take the first question from the line of Harit Shah from Reliance Securities. Please go ahead.
Thank you. Congrats on a good set of numbers. I just had a query regarding your, the PNC segment. Of course, we've had some headwinds in this segment for the last almost, couple of years now. Growth in the last 1.5 years has obviously been led by the LNA segment for reasons that are reasonably clear now. So I just want to get a sense of, what is the outlook in this segment for the next, 1 or 2 years now, because given that the segment accounts for some more than 70% of Majesco's revenues, so some sort of clarity on that would be appreciated.
Sure. So, I think the PNC segment clearly represents the transition to cloud, which I mentioned before, where we had a significant traditional on-premise business in PNC segment, which continued to decline. On the other hand, if you see the new deal flow, majority of our new deal flow came in the PNC segment as well. But this segment, these new deals did not have the initial high revenue. So the net of that, we saw a declining trend in PNC. But we are at a stage where we are now seeing the reversal of this trend, and the cloud revenue of some of the deals we signed before has started ramping up. So I continue to feel good about the pipeline and the opportunities to close the new deals in PNC. But as I mentioned, we see these deal sizes are small. The most carriers start with a smaller initiative and then scale up and grow. So we have clients at different stages. Some of them who started some time ago are now in a position to scale. Some new ones are starting relatively small.
Right. So, given this trend, as you rightly said, the initial deal sizes are quite small. So is it likely that you may see some sort of growth in FY19 in the PNC segment? LNA, of course, is ramping up very nicely. But at least as far as the PNC segment is concerned, is that a possibility, or you may, see flattish revenues in this year as well?
So I think one of the lead indicators that we've given is the cloud composition in the backlog. Okay. And last year it was 29%. Now it has grown to almost around 40 to 43%. Okay.
Correct.
Which effectively means that this cloud revenue cloud backlog will kind of revenue in the next year. Effectively, large part of that cloud revenue comes from the PNC.
Right. Okay. I don't know if I missed this figure. Can you just give a data in terms of the percentage of order backlog that is part of PNC?
Oh, so we don't give the breakup, especially in PNC and LNA. What we've done this time is, in the total backlog, we've given a cloud composition, and that has now gone up to almost around 43% as compared to 29% in the last year.
Right. Okay. Thanks. I'll come back if I have a follow-up. Thank you.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Rahul Jain from Emkay Global. Please go ahead.
Yeah, hi. Congrats on good quarter. Two questions. Firstly, we saw good momentum in the LNA side of the business, but we don't see new additions on client side in this business. So is it to do specifically for the largest deal that we are executing in the segment, or any other color you can give on that specific deal? A. And secondly, or maybe I'll come once you answer this.
Sure. So we do have pipeline of opportunities in the LNS segment. After we signed up and as we are executing MetLife deal, our profile in the industry has significantly gone up, and we are seeing a pretty good pipeline. In general, the number of deals or activity in life and annuity is not as robust as what we see in the PNC side, but we see a growing pipeline for LNA as well.
So, Rahul, just to add, the deal flows that happened in the UK and Asia Pac are largely on the life side. Yeah.
So what I wanted to also understand here is the current revenue growth run rate from a QOQ or a YOY perspective in this particular quarter. Is it driven by this one deal, or there are more legs to it?
No, there are more legs to it, and if you see, there has been clearly an increase both in the UK and Asia Pac in terms of the revenue, which is largely coming from life. So it's not just the MetLife, but MetLife has been the large contributor. The others also have grown.
Okay. And secondly, on the on this new deal or the total backlog data that you gave, there is a significant jump in the data from a total order book perspective, which you said is around $220 million. If I see the QQ run rate is, barely moving during the quarter. I mean, up by 2-3%, and similarly, the 12-month book has also not gone up significantly. So does that mean that orders that we would have won during this particular quarter had a strong, much larger, staggered revenue, which is beyond FY19?
You're right, Rahul. What we won in terms of deal flows are pretty good size cloud deals, which have revenue that will flow beyond the 12 months. So what got added in the 12 month was a very small quantum, but there is a back-ended revenue in that 220 million that is coming.
So can we conclude that this is around 55-60 odd million of new business that we have added in the quarter?
Yes, you'll be able to derive it based on data points that I've given in the previous calls.
Right. And secondly, if these deals have very small on recognition upfront, as long as 4-5 quarters, does that mean these deals have more committed from a long-term, deal value of this particular project, wherein because there are lower, premium processed, so those revenues from a 12-month basis would not be significant, but as they add more lines of business and more premium, that is how the deal would shape up from a recognition perspective.
Yes, these are long-term deals, anywhere between 5 to 7 years.
And if we have to apply some kind of a basic thumb rule, so what would be the, how these, let's say, $100 deal get spread from a 6-7 year perspective?
Yeah, so it will vary, Rahul. There is no strict formula for every dollar how it is spread. It is different for each deal.
Yeah, I completely understand, but from a, or you can say which is the best scale year from a recognition perspective on a thumb rule basis of a 7-year deal?
So one of the deals that we won is actually basically the specialty insurer in one of our existing client actually, okay, and that will bring in pretty, I would say not even, but I think beyond the first year it will be more or less even kind of revenues in that business. So as I mentioned again, it is not there's no thumb rule. It is different for different deals.
So let me add to that is the way typically we see the trajectory going is that the first year the book of business we put on the platform is relatively small. On second and third year it reaches the peak and then it flattens out if we reach the full volume of the business of that client by third year.
Understood. That's quite helpful. Just one more, if I may. Ketan, you alluded on the qualitative factors that you have seen after this MetLife transaction. So if you could share what are those incremental things that has come in our favor post we going for the implementation of this deal?
Sure. So basically what I see is that within life and annuity, the group and the voluntary product is a very strong segment where we see increased interest in the investments by the insurance carrier. And MetLife is clearly one of the top carriers in that segment. And what MetLife is essentially doing is a complete digital platform to process and grow their small market business, which is less than 100 employees. Now, most carriers recognize that this segment of the market is the fastest growing segment and it has the huge growth potential. But a digital platform and a straight-through processing are very important capabilities to really address the needs of that market. And MetLife certainly has taken a lead, but there are other carriers who are interested in looking at the similar opportunities to grow and take advantage of this group market. And over a period of time, Majesco has developed a very strong and comprehensive platform to address the voluntary benefit market, which allows an individual employee level selection of the products and services which they need. So we find increased interest and investment in this segment of the market, and we have a number of pipeline opportunities in this segment.
Okay. Got it. Thank you. That's it from my side.
Thank you.
Thank you. Before we take the next question, a reminder to the participants. If you wish to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Chirag Patel from Patel Investment. Please go ahead.
Hello. Congratulations for the good numbers.
Thank you.
My question is, your one subsidiary...
Excuse me, Mr. Patel. I'm so sorry to interrupt, but requesting you to please use the handset mode. Your voice is not very audible.
Here, one of the subsidiary is facing one claim of $10 million from one of the client. Which subsidiary it is?
It is the Majesco's software solution actually in the US, which is a PNC client.
Okay. And regarding what the claim is?
So this claim was for the policy administration implementation, where the clients saw some performance issues on our delivery. Subsequent to that, and this client is not only using policy administration but billing system. Now, billing is working fine and it's in production with the client. And subsequent to that, we are engaged with the client and we have delivered new product which we believe would significantly improve the performance. Client has promised to test this in the following quarter, and if the performance meets their needs, we expect to have a resolution to this claim soon.
Yes, you expect the resolution will come by the next quarter or from a next 6 months?
No, so they will plan to test it between July to August. So I think it will be only post that.
July to August in FY19.
Yes.
Okay. And you also mentioned that this entire claim is being covered by insurance. Is it 100% amount or lump sum?
No, we have adequate insurance cover to take care of this claim, and more so from a financial, from a books of account perspective, the entire outstanding that was there to be received from the client has been 100% provided for. So there is no further impact to P&L unless we see something which is different post August.
Okay. And from the cloud revenue point of view, what kind of growth you are expecting for the next year? Deal traction as well as in absolute term.
So the pipeline opportunities are very strong, and Ketan did mention about that. We don't guide to any revenue growth for next year, but the data point that we have given is the cloud composition in the backlog. So that will give you an idea of how the cloud revenue will grow next year.
Okay. And one more question. In your one of the last con call, you mentioned that for the US-based subsidiary, which is listed on Nasdaq or you started covering the stock from analyst point of view. Is it at what stage right now? Are more analysts covering that stock or not?
No, so US obviously, as you would know, it's a different market, and the analyst coverages have a different kind of situations because it's a very micro cap with not much trading and liquidity. It is really very difficult to get analysts to cover because it doesn't work to their advantage. While Maxim has been covering us, we don't have very much active coverage at this point in time in the US.
Okay. And in recent last 6 months, you won very good client deals from Indian market. So from next 2 to 3 years point of view, are you targeting Indian market at right now you're doing good numbers of traction in US market. So your focus is shifting for Indian market?
So India as a proportion constitutes just around 2%, a little over 2% of our revenue. But if you look at the market, it's a very promising market. There is a lot of activity happening. You would be reading a lot about the consolidation, about the kind of spends that are happening, the monies that are there for investment in the India market. So it remains a core market for us. It remains an important market, and we believe that we'll grow pretty well in terms of percentage pretty well, but in proportion to the overall revenue, obviously it's not going to make a significant dent when you look at it, since it's just 2% of, little over 2% of our revenue.
In global market, your client concentration is more shifting at the higher weightage in North American market, and even UK portion is slightly down this time. So are we shifting global market also, or just concentrating one particular country in North America?
No, the three focus markets for us the 4 focus markets for us has been US, where significant part of business comes from there, almost around close to 87-88%. UK has had impact in terms of certain projects that got completed. So UK is still a market that we believe will grow, and there is a good deal pipeline building over there. Asia Pac remains a very, very promising market because there's a lot of deals for momentum across various Asia Pac countries. And I already mentioned about India. So we'll keep the focus on these 4 countries. There is potential to go to other countries, and it will depend upon how we get into those countries. Just for information, this year we opened up Singapore in the Asia Pac market, and we believe that there could be a potential to open up another 1 or 2 markets in the Asia Pacific region. beyond that, I don't think we would like to get to too many regions at this stage.
And I think our approach is to go to the international market with the existing clients. So for example, we had done a program with MetLife in Mexico, and then we are likely to get an extension of that program in other South American countries. Similarly, we signed up a policy admin system for a very large international carrier in UK for group platform, and they are looking at extending that platform in other European countries. So we find number of opportunities to work with our existing clients to go to the adjacent countries.
Okay, so thank you.
Thank you. We take the next question from the line of Amit Chandra from HDFC Securities. Please go ahead.
Hello. Yeah. Thanks for the opportunity. So I just wanted to know that, as you said that there was a 25% drop in the legacy revenue. So as you said that the legacy part is predominantly in the PNC vertical. So the drag in the PNC, the legacy part of the PNC is more serious. So I just want to understand that how much of the existing revenue or the 174 clients that you have, so how many are on pure legacy portion, and like last also you mentioned that you have seen some stability on the legacy revenue, but it seeing the numbers, it doesn't seem that way. So for FY19, how do you see the legacy part of the business? Has it stabilized, or we can see further track there?
So, Amit, the good part is that there has been some stabilization. If you look at the drop, and I'm just giving you some more data points, the drop in the on-premise revenue has just been a little over 1% in this quarter. Okay, so this points to the fact that the kind of drop has has been now lower. Okay, but yes, there are some projects that will also get completed in the next year. However, the bulk part of the impact has already happened in this year, which was a 25% degrowth. Okay. Keep in mind that the on-premise business still remains predominant in the UK and the Asia Pac regions, where we're going to see growth. Okay. So overall net, I don't see too much of an impact, except for the projects that will get completed in PNC in North America. Otherwise, it should be stable. Further, the cloud business and the growth in the cloud revenue, and especially subscription, should more than offset any drop in the PNC, and we should see a growth in the PNC actually in the coming year. Okay.
So like in terms of the number of clients, can you give a idea that out of 174, how many are on pure legacy?
I don't have that data point with me, Amit, right now, so I'll have to get back to you.
Okay, sir. Okay, sir. Thanks for that.
Thank you, Amit.
Thank you. We take the next question from the line of Ritesh Thakkar from Qtr4. Please go ahead.
Yeah, congratulations for the strong set of numbers. Sir, could you please clarify on the employee expenditure part, which has increased significantly during the quarter, despite our headcount remains flat? Is it because of ESOP, or even though despite if we see the R&D expenditure have declined? So could you please apply more color on that? Like, why is that increase?
No, so I think your voice just faded in the initial part of the question. Can you just repeat? Can you just repeat that question?
Yeah, there is a significant increase in your employee expenditure. So why it has increased?
Yeah, so it's obviously there has been a marginal increase on account of the ESOP expenses, which has been in this quarter as compared to the previous quarter. Secondly, based on the overall kind of performance that we've had in the year, whatever there is a basis on which we would provide for the incentives. So that has also been added in this quarter.
Okay, got it. And sir, Ketan sir has mentioned that digital first. You have come up with a new platform that is digital first. So how is it how is it going to benefit the insurance carrier in both PNC and LNA? And any color on that?
Great. So I think digital first platform is essentially, there are multiple components to the platform. The core digital first platform is a platform to build insurance applications very quickly. So it's a microservices based architecture, which means you can unbundle the services or select small pieces of services and put it up very quickly, as opposed to a monolithic application. And so we find if, for example, you want to build in new types of insurance products like on-demand insurance or payment or insurance for ride-sharing insurance, which typically an Uber type of drivers will take, it's really very digital first platform is an ideal for those types of innovative insurance products. Secondly, if you want to build a customer engagement, personalized journey-based customer experience engagement app, then this platform allows that and facilitates those types of personalized experience journey builders, which is much faster than what it takes to build a traditional book portal. And you can actually personalize for different types of personas of your clients. In addition, the platform also has an eco-exchange component, which is it's a marketplace for insurance applications. Think of that is almost like an app store in your iPhone, where it's easy to, at a one go, one can integrate various InsurTech capabilities. And eco-exchange will not only connect with the Majesco platform, but it is open architecture and it will connect to other platforms as well. So these are some of the possible use cases of the digital first platform.
Okay. Thanks a lot. It's helpful. Sir, one more question on IBM MetLife deal. There is a significant jump in LNA revenues, that is, which has increased, which contributed in the last quarter. It was 23%, and during this quarter it is 27%. So, is it coming from the IBM MetLife deal? And what is the contribution from the deal during this quarter?
So I did reply to this question to an earlier question that came in. There has been a good contribution from that MetLife deal, but there has been growth in the LNA business in the APAC and the UK region that have also contributed to this 27%. The IBM as a contributor is almost around 9% of our revenues, approximately 9% of our revenues for this quarter.
Okay, got it. Okay, and sir, one more last question on the QIP fund which we raised previously of 2.3 billion. So, how are we going to apply this? Do we have any strong contender in our hand, like any startup or greenfield are we going to acquire in which area, like in the US region or in the UK? Do we have any clarity on that?
Sure. So, as a part of our acquisition strategy, we are looking at different types of options. In US, we are looking at enhancing our capabilities for our cloud platform. Some of the areas we are looking at includes predictive analytics and AI integration to our platform. In addition, we are also looking at international market opportunities as well, where we can further strengthen our position. So, we have a pipeline of opportunities which we are currently evaluating in terms of acquisition.
Okay. Thanks a lot.
Thank you.
That's it from my side.
Thank you. We take the next question from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Sir, this year has been kind of year of transition from on-prem to cloud. So, can we say that next year will be a pivot in terms of growth, that, we can see material improvement in the top line growth of the overall portfolio?
That would be the expectation based on a leading indicator whether the backlog itself has grown by 41%, almost 40% as compared to last year.
Okay. And second, sir, this IBM deal, now how is it helping us in terms of a reference client and a client base, the MetLife deal? And have we had any good senior level conversations for the new client wins?
So certainly it is one of the largest cloud deals in the industry. So it has a huge reference value in the industry. So it's helping in many different ways. And we do have a growing pipeline with IBM team as well post this deal with other carrier opportunities. So it has significantly boosted our IBM partnership energy as well.
And when we talk about new markets like Europe and APAC, which is still a small part of our revenues, how is the sales cycle? Because we are hardly present there. I mean, what could be the cost of sales? I mean, when you want to expand rapidly over those areas, what is the gestation period for the sales cycle now?
So UK region is obviously takes some time. What we are seeing is that the closure period is anywhere between 12 to 14 months in order to close a deal in the UK. Needless to say that we are looking at other smaller deals where, there could be a possibility for us to get the deal through faster. Comparatively, in the US, we are seeing that the time to close has been reducing. In fact, in the US, we are seeing now we're able to close deals a little faster than what we were in the last year.
Okay. So acquisition would be even to expand on the geographical front, the M&A which we would be looking at?
Yes, but only in the adjacent market, okay? So where we see the opportunity and where we see a potential.
On the property and casualty, predominantly.
It could be in both, but typically, it should be a potentially good market for growth and where we can obviously sell some of our enterprise and digital forays in that market across those customers.
Okay, sir. Thanks.
Welcome.
Thank you. We take the next question from the line of Harit Shah from Reliance Securities. Please go ahead.
Yeah, thanks again. Okay, just, we had mentioned about the acquisition opportunities and the discussion. So any particular deal has, gone to any advanced levels at all, or as of now we are still very much in the formative stages of, any potential acquisition that we can use with, acquire, we can go ahead and do with the funds that we've raised, or, is any color on that right now?
No, I cannot give any timing for acquisitions. You know how difficult it is to kind of even suggest the timing for this. Each of the targets that we are looking at, and obviously we are looking at multiple. So it will take time. I mean, I cannot determine the time at this stage.
Sure. No, so my question was essentially, have you been able to get into any advanced discussions with any potential target, or that is not?
I will not be able to comment on that.
Okay, fine, no problem. Thank you.
Thank you.
Thank you. We take the next question from the line of Viral Bansani, individual investor. Please go ahead.
Yeah. Good evening. Good evening, sir. Thank you for the opportunity and congratulations for a good set of numbers. Sir, my question is regarding your US subsidiary, which is, as it is not very thinly traded on the exchanges. Are you thinking on the lines of delisting that company by any case, any chance? Because that would I ask this question is because when I go through majority of brokerage reports, they accord a holding company discount to Majesco when valuing our company. So that would, if you delist that company, that would effectively eliminate the holding company discount of Majesco. Are we thinking on those lines, sir?
So we understand that the dual listing has certain pluses and minuses, okay, and at some stage we will have to kind of get a resolution to this. At this point in time, we have not come out with any suggestions to either delist or do anything else on this aspect. But we take your point. I know that having a listing which is a dual listing in the US where the reference price may not be the right price, and then the analyst giving a holding company discount, I understand that very well. At some stage, we will have to get a resolution to this.
Thank you, sir. And my second question, sir, is regarding bookkeeping. Are we expensing out all R&D expenditure, or are we capitalizing some of these?
100% of the expenses, 100% of the product expenses are completely expensed out in the P&L. We don't capitalize anything.
Thank you. Thank you so much, sir.
Thank you.
Thank you. Well, that was the last question. No further questions from the participants. I would like to now hand the floor over to the management for their closing comments.
Thank you very much to all the participants for their continued interest and being on this call, and appreciate your feedback, and we look forward to kind of interacting with you in the next quarter. Have a good day.